This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author, publisher of the website Dollar Collapse. Good morning, John, and welcome back to Macro Analytics.
Morning, Gordon.
John, we've had some major developments since we last talked, with the Fed announcing unlimited quantitative easing and the European Central Bank announcing what I'll term as uncapped OMT or SMP2. And I thought this morning we should talk about what all this unproven monetary policy might mean. We've been following a roadmap that continues to unfold, and I believe the central banks are playing a critical role in making this happen, whether intentionally or unintentionally, and I will leave that to the listeners to decide on. To frame this discussion, I thought we would break the Fed and the ECB actions down into three categories: moral hazard, unintended consequences, and dysfunctional capital markets. But before we lunge into the specifics, I thought we might make sure we are all referring to the same thing by defining the terms first, then getting specific with each one of them. And I have up now a chart that really lays out moral hazard, the definition of moral hazard, and examples of it as we go through. John, how do you define moral hazard?
A moral hazard is where the risk-return ratio has been skewed by some external agent. And so if you're a player, if you're a trader or a banker or a corporation or whatever, the normal sense that by doing something you're taking on risk isn't there anymore. You're going to be bailed out in some way. And so your rational tendency then in that kind of a situation is to take on a lot more risk than you would have normally. And when you spread that across a whole system, you get a completely different financial market or economy, because you've got people out there taking risks that would normally be kind of crazy, but in the situation where they're probably going to be bailed out, seem very rational. That's where we are today. You know, we'll dig into the reasons for it in a minute, but the situation that we see in general out there now is that people feel a lot more comfortable taking extreme risks than they would normally.
You know, one of the examples that I actually listed here in the second one, which really kind of brings it home to me, is, for example, the Euro debt crisis. Now, here we have the Troika, the relief funds for heavily indebted nations like Greece, are waiting as long as possible to act. And so, but what's happening here, the risk of a money run, the consequences of a market crash in Europe, is by far not as detrimental to them as the indebted nations themselves, because there's advantages to them to defer it, to pass it on, to extend it. But it certainly isn't in the benefits of those who are in trouble, the indebted nations themselves, because of what will happen to them. So there's reasons why some would do it, but not necessarily who's going to win and who's going to benefit from it. And I thought that was a very clear example and a blatant one of what's going on, and maybe a little more subtle than most would suspect.
Oh, yeah, Europe is a fascinating example of this, because if you were in the market for government bonds, for instance, if you just looked at Spain's or Italy's numbers, looked at their balance sheet and their income statement, you would probably shy away from lending them money, which is what you do when you buy their bonds, for 10 years at 5% or something like that. It just wouldn't look like a good deal. But because you've got the European Central Bank as a backstop now, basically agreeing to buy as much Spanish and Italian debt as it takes to keep their interest rates down, all of a sudden it's a good deal. So you'll take that risk when you wouldn't have taken it otherwise, because you've got somebody backing you up. So you end up doing things that you wouldn't have done otherwise. The net result of that is a dramatic increase in the amount of debt that the Spanish and Italians are able to issue, and cumulative increase in the amount of risk that's in the system. So by individual bond buyers taking on more risk than they might have otherwise, you create a system with a lot more risk aggregately than was there otherwise, and a lot more fragility. So we're creating the conditions in which you get the potential for a catastrophic crash out there. But it's a lot of individual decisions people wouldn't normally necessarily make, but they're all making it because they feel like they're going to be bailed out.
We could talk a whole show just on moral hazard here and examples of it. And I grouped them into minimally three different areas of defining moral hazard that's going on. The first one I'm showing here, what it's doing is it's forced risk-taking into the market. More risk-taking than people did before. And that's because when you get low interest rates or low zero ZIRP, zero interest rate policy, two things happen. Money becomes more available, assuming you have collateral and credit to get it. So much easier to leverage up. But at the same time, because returns are so low, it takes more and more leverage to get it. So money's easier, but it takes more money to make the same amount of returns. And so, or what was an acceptable return before. So pension plans used to have 8-9% kinds of returns. Now they're lucky if they're looking for 2 and 3%. So how do you get more? So you see banks running leverages of 35 and 50 and private equities, et cetera. So then you have people that are speculating and gambling today, I would use that terminology, versus really investing. Short term, high risk, and that's a shift. Would you agree with that point, John?
Oh, yeah, absolutely. But it might make sense at this point to take a step back and talk about how we got to this point, because the fact that interest rates are extraordinarily low and there's amazing amounts of money flowing out of all the world's central banks is something that, we kind of get, but we should know why it's happening too. And the source of it basically is fiat currency. In 1971, the U.S. basically took the world off the gold standard, and which in effect handed an unlimited credit card to the world's governments. From that point on, we could all print as much currency as we wanted or cause it to be created electronically. And no one at that point had to prioritize anymore. The U.S. was able to create a cradle-to-grave welfare state at the same time it was running a global military empire, partially paid for with borrowed money. And that has led to all the pathologies that we see around us today. We're so indebted because of 30 years of not having to prioritize that we've had to, in order to keep the system from collapsing under the weight of all the debt we've taken on, we've had to lower interest rates to basically zero and basically agree to, in advance, bail out any major corporation or bank that runs into trouble. And so everybody knows this now, and that skews everyone's decision-making process. So you get what you just talked about now. You get extremely low interest rates that make it impossible for anybody who needs yield to get yield safely. If you're a retiree or a pension fund and you need 5% or 7% to meet your planned for obligations, you can't get that anymore in relatively safe bonds, which is what, historically you've gotten. And so you've got to move out on the risk curve and take bigger and bigger chances with your money. You see pension funds going into quote unquote alternative investments or equities or whatever, because they need a higher return. You see savers doing the same thing. Retirees buying growth stocks, which used to be considered really excessively dangerous, is now the norm because that's the only way you get enough money to survive. And so in the process, we're creating a more and more fragile global balance sheet, or the debt that we've taken on is a lot lower quality and a lot bigger. And because of that, we're extremely fragile and we're extremely, prone to a catastrophic failure of the whole system. And that's the end result of a global system in which moral hazard is pervasive. And so, now the question is, where do we go from here? Because we've created a system in which moral hazard is basically everywhere. And, we should, when we have a chance, get into some examples because they're not always obvious and they're always interesting of how the system is being perverted by low interest rates and easy money. But suffice it now to say that the system has changed dramatically from the 1950s, 60s, 70s, and it's a very different system. And in Austrian economics terms, it's an extremely fragile system. It's something that's on the verge of falling apart.
Later on this week, John, in our second show, we're actually going to talk about some of that. We're getting into some of your writings where you're talking about seeing things like instability ahead of us, and it's for exactly the reasons you just expressed. Another element of the moral hazard that leads from what you're saying is that money, because of the increase of it, is no longer a store of value. And when the Federal Reserve note, the dollar, is no longer a store of value, what it's effectively doing, it's lowering living standards. And how it's doing that is because your real disposable income is being crushed. Anybody who is, in fact, not making money out of capital gains and asset appreciation, if they're lucky enough to be in the right assets, but from an earnings standpoint, are not keeping up. And whether it's the inflation element or the wages themselves, not keeping up because of shrinking benefits packages, whether health care, pensions being moving from a defined to a contributory plans. In that element, the moral hazard of these policies that are coming out of these central banks are in fact the cause of these issues. And I think a lot of people just don't see the linkage, but this is part of the moral hazard. Another one I'd mention here, too, is something maybe even more subtle. When you talk about kicking the can down the road, extending and pretending, fake it till you make it, these kinds of never-ending, for me it's been 4 years of this, what happens is when you're doing that is you open the loop. You don't have a closed loop. And by closed loop, I mean there has to be consequences of bad decisions, whether the bad decisions means a company goes bankrupt, it's failed, it's not allowed to continue, or people feel the pain of their homes, they've lost money, and so it changes behavior, and therefore you get a corrective element. That's what makes capitalism work over the long haul. There's risk, there's reward, and there's penalty. But what we've done now is with unlimited bailouts, with unlimited amounts of government coming in, whether we're talking about automotive industry, banks, whatever we're talking about, if there's going to be pain, the Federal Reserve covers it up with liquidity. And therefore what happens when you don't have that corrective action, you get moral hazard. All of a sudden behavior changes. And that's another reason some of the changes that are happening in America, for the old timers, they say it doesn't make any sense to them anymore.
Oh yeah, can you imagine being an old style banker in this market, where there's really nobody left who's a good credit to lend to, and yet the government is still giving you huge amounts of capital that you're supposed to do something with. So you have a choice of either going way down the quality ladder and lending money basically to anybody who can sign their name, or sitting on all this cash that the government's given you and generating really low returns on your capital, while Goldman Sachs and JP Morgan Chase basically just do whatever they feel like and report better earnings and look smarter than you, and then you get fired and replaced by somebody who's willing to basically lend money to anybody. And that's been the situation in the last 30 years for the U.S. banking system, and that's why we ended up with the guys that we ended up in charge of the big banks. You know, they were the result of a process of selective breeding, basically, in which bad bankers ran good bankers out of the business because money was so easy. And you get that across the board in the whole corporate sector, especially in the U.S., but also in the rest of the world. And so we're seeing a lowering of the moral standards and the professional standards of basically anybody who's involved in the financial sector right now. And it's even been reinforced after the 2009 crash because the guys in charge didn't face any consequences. The people who caused most of the mess are still in charge, whether it's in the government or in the big banks. You know, they've just been handed more money and told to go out with this money and try and fix things. And so, the people who, did the screwing up have walked away rich, or they're still in charge and getting richer. And that sends a signal to everybody in the market.
You know, when we came through the 2000 stock market crash or the tech bubble, we had a lot of people going to jail during that period of time, whether it was Tyco, WorldCom, Enron, I can go on, who got 20, 25, 30 years of hard time as we worked through. And before that, when we had RTC problems with mortgages back in the early 90s, I would challenge, John, anybody to say who went to jail or serving time have anything to do with the 2008 financial crisis. We're not even prosecuting anymore. Meanwhile, we have an open loop. There's no change. there's no penalties, therefore the moral hazard just continues. John, we need to, for sake of time, move along here to the second one. As I said, we could do a whole session or two just on moral hazard, but I want to make sure our listeners at least get a sense of why yourself and myself, we feel so strongly with a lot of these Federal Reserve, central bank, ECB policies, why they're fundamentally flawed and what things they cause. Now, the other part of it is unintended consequences. Once you have moral hazard in place, and unintended consequences are a little bit different. They're maybe a little more self-explanatory. They're the outcomes that are not the ones intended by the initial actions. So you thought you were doing something, but it turned out it may have achieved that, but a whole series of other things that you didn't believe would happen. And we can debate sometimes, John, whether in fact they were unintended or they were intended. But anyway, they're I'll call them collateral activities that happen that are secondary. How would you define it?
Well, I think the examples of unintended consequences that flow from easy money are very interesting and very real world. For instance, all this hot money that we're creating by trying to inflate away our debt doesn't just stay here in the U.S. It flows out into the world, and it distorts the economies of other countries. For instance, Switzerland, which is running a reasonably sane economic system right now, is seeing so much hot money flow in because everybody's afraid of what's happening in the U.S. and in Europe, the rest of Europe, that they have had to peg their currency to the euro and offer to print as many new Swiss francs as it takes to keep their currency weak, which means they've tied themselves to the euro's inflation rate from now on, which is something they never intended to do. And if that doesn't work, they have to go to capital controls where they just flat out prevent new money from coming in. Same thing happened with Brazil. They had to impose really draconian capital controls to keep hot money from just distorting their economy and causing an internal inflationary spike and pricing their export industries out of the world markets. And Asia's the same thing. All the major Asian countries have various kinds of capital controls imposed to protect themselves from U.S. and European economic mismanagement. And that distorts their markets because you don't have a free flow of capital into the most efficient uses when you've got rules about who can do what and prevention of money coming in and going out and everything. So you lower global efficiency. At the same time, you increase global fragility. And these are completely unintended consequences. I don't think anybody thought about this ahead of time. The U.S. is basically just trying to get through the week. They need to keep interest rates low enough to avoid a deflationary crash and screwing up the next election. That's all they're about right now. They don't have a master plan or anything. Now it's just on autopilot. They're doing what it takes to keep the system from falling apart in the short run. And the consequences of this are felt in every sector of the economy. We talked about how people are being pushed up the risk curve by doing this. And, the collapse that will come in retiree incomes the next time the stock market tanks is something that the government doesn't intend, but that will absolutely be a consequence of this. And, big banks are using their too big to fail status to borrow money more cheaply than smaller banks that are actually better run. And then they're able to price mortgages so cheaply that they're pushing the little banks out of the mortgage market now. And a few big U.S. banks control almost the entire mortgage market. These are things that probably weren't expected at the time, but are kind of logical outgrowths of the kind of stuff that we're doing.
Times I think maybe it's more Machiavellian and there's a plan, but I do agree, John. I think in many cases the central banks are really naive or possibly just so focused, as you said, on the short-term issues of the day-to-day or the next quarter that some of the issues they just aren't worrying about to the degree they should be, and the list is long. The whole area of what regulatory arbitrage is and unintended consequences. And that is passing the debt and the obligations from who originally took it, the banks, and passing it where the sovereigns and the countries around the world have assumed it, and that has been massive and ongoing for 4 to 5 years now. The fact we have a $700 trillion derivatives market, unregulated, unsupervised offshore, that's really about interest, currency, and credit swaps and how they're priced that's being used to be able to handle and to offset a lot of these policies that are being brought out. That is zero interest rate and the amount of bailout money that's been made available. You've got capital concentrations that we've seen ever since we brought in lowered interest rates. Tech bubble, housing bubble. I believe we're now in the middle of a bond bubble. We have global behavior that's outside of the central banks themselves, so that what they do in one country is spilling to countries that are relatively good. So you see Canada and Australia being the recipient of these unintended consequences and forcing them into behavioral shifts and policy shifts. The list is long, but there's just so many unintended consequences that are going on here that now are becoming entrenched in our system and are leading to much more serious problems, and that is what I'll call dysfunctional markets. And that's where we're now at, John, is we've now got, I believe, dysfunctional capital markets around the world. Would you agree with that?
Oh, absolutely. Gordon, let's talk a little bit more about derivatives, because I think that is the best story out there.
One of my favorite subjects, John.
In 2009, the global derivatives book was absolutely gigantic. It was several $100 trillion. And it blew up. It would have brought down the global financial system. Now, these big banks generate money up front when they create derivatives. They generate fees which go into their quarterly earnings statement, which flow into their year-end bonuses. Okay, so the guys running these banks make a lot of money by doing derivatives in the short run. But they found out in 2009 that if the derivatives blow up, as anything that big is eventually going to blow up, they can go to the government and say, look, the financial system is going to collapse unless you buy us out of these derivatives. Taxpayers have to assume our risk. And the government did it. They bailed out AIG and in the process bailed out Goldman Sachs and JP Morgan Chase and allowed those guys to continue to make record bonuses year after year. And so the bankers learned that lesson. So in the meantime, instead of derivatives getting smaller and smaller and more legitimate, the market has grown. Now it's $1 quadrillion notional value of derivatives out there. But the bankers know that number is so huge that if it goes bad, the global financial system will totally collapse. It'll just grind to a halt. And so they know no government will allow that to happen. And so to them, this is risk-free money. They're generating quarterly earnings and nice annual bonuses, knowing that the taxpayers will have to pick up the bill eventually, but in the meantime, they get very rich and they're going to get to keep that money. And that if anything is the definition of moral hazard, that's it. These guys are behaving in ways that they would never behave if they had to eat the losses that would flow from bad decisions. But because they know they don't have to, they're just letting it all hang out. They're doing anything they feel like right now. And, they're writing derivatives as fast as their back offices can process the paperwork. And we are on the hook for that.
Perfect illustration of something between malpractice and malfeasance. And the difference here between malfeasance is really where it's borderline illegal or immoral at least. And in this case, it's not illegal because there's no laws against these sorts of things to any extent. But certainly you get into malpractice because when you execute some of these on another element, look at most recently JP Morgan and the whale in Britain, and it was really, when you get inside of it, was them on the side of this $700 trillion swaps marketplace and trying to play and move and the moves associated with JP Morgan itself handling something close to $73 trillion in derivatives. Because of this, then you get mispricing, you get malinvestments, and when you link those all together, suddenly it's almost delusional. And suddenly nobody can make good decisions. And decisions where they know that the return is sound. They stop being investors, they start being speculators, and frankly, John, with the casino guaranteed to win today, they've become total gamblers, but they don't own the casino.
Yeah, and if you want to stay in these games, you have to behave this way because that's all that's left. There's no legitimate lending at the margin anymore because everybody who deserves money, based on their balance sheet and their income has plenty of money. They've already borrowed a ton. And so the only way to continue to stay in the banking game is to do things like derivatives or trading for your own account. Set up a big trading desk and try to scam the markets, or create new derivatives in a torrent, knowing that they're going to blow up eventually, but reaping the fees in the short run. That's how you bank right now. If you're a big bank, small community bankers still do legitimate work, but they're being pushed out of most of these markets by the big guys who have unlimited cash for next to nothing.
See, the flaw in this whole process, and why some would say, well, if people are making money, why wouldn't it go on? It can't go on, and the reason is it's capital destruction that's going on. We're consuming our seed corn in terms of capital is being used for more and more consumption or paying debt. And those that are in the capital markets that we were just talking about are basically, if we were moving paper around, but we're destroying capital. It's being eaten up at a phenomenal rate, whether you want to call it deleveraging. And central banks are having to put money in because of the amount of deleveraging. I like to not say it as deleveraging. I call it non-performing loans that are just no longer support the underlying asset value. That's what's going on right now. But the bottom line is we have massive capital destruction beginning and accelerating, and that's where it implodes. We're up against our hard line here in terms of a time, and as we said, there's just so much to talk about. Any comments you want to make?
There's so many examples of horrendous stuff that's being done out there that when you hear about it and you actually understand it, it's outrageous. You cannot believe this stuff is happening in the real world, and yet it is. And so historians are going to have a field day untangling all of this and trying to make sense out of it. And the other thing that it would be good to finish up with is to go back to malinvestment. Especially, you used to hear Alan Greenspan speak about this, and I think Ben Bernanke seems to have the same attitude, that investment is a good thing by definition. In other words, any money put into some kind of capital project is inherently good, but that's not true. As you said, malinvestment. If money flows into a stupid project that doesn't have any kind of a chance of paying back its investment in a reasonable amount of time, that's actually capital destruction. And so what we're seeing, because our capital markets are so distorted right now, is a huge amount of quote unquote investment that's really malinvestment, which is really capital destruction. So a lot of our money that we think of as flowing into productive uses is actually just being wiped out. It's being destroyed. And that means we're getting poorer and poorer even as we build new things and, invest in new projects and stuff like that. And we're not going to see the results of all this for a little while, but at some point we're going to wake up to realize we're actually far poorer than we thought we were. And, I did a series of articles called Welcome to the Third World, which, chronicles the how this is happening in different parts of society. And it's happening everywhere. Money flowing into different sectors of the economy is basically just going down a hole, just disappearing. And we're getting poorer and poorer. And that's a direct result of the stuff we talked about today. Easy money leading to moral hazard, leading to malinvestment. And the process is, if anything, it's gathering steam. So things are going to get worse instead of better going forward.
The roadmap that we've been following, John, is in fact accelerating. And things such as the Fed's policies is accelerating. And when I say the monetary malpractice of the central banks, I'm talking about the moral hazard, unintended consequences, the dysfunctional markets that it's led to. And it takes a while to build up. And so we've had probably the best part of the first decade of this millennium building up, but we're now at the point where it truly is accelerating, and where it leads is, unfortunately, I'm concerned, and we've expressed that before. John, we need to wrap here for time. Could you tell our listeners how they could learn more about your writings, the things you work on, and your website?
I run dollarcollapse.com, which is a blog/news aggregation site that covers a lot of this stuff on a daily basis.
John, we're going to pick this subject up here later this week, and we're going to talk about instability and what you see as some concerns with deflation. So until then, talk to you later.
Great. Thanks, Gordon.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.